Hi friends, welcome to Market Monday. On Mondays, we always talk about the stock market, what's going on, what's happened. So, I really love this video that I'm making today. The reason being, it ties into what I want to share with you guys. The market has behaved in a way that it really ties into the message. So we started this year with the market going into a downturn, and if you remember, I begin to tell you all about volatility, how to keep investing, even if there's a fear of a recession or a bear market. I've tried to encourage you all to keep investing. Well, last week, for the first time since the beginning of the year, we had a week where the market was green and it's recovered a lot of the losses it's made so far this year. For example, the S&P 500 recovered about 6% last year and the Nasdaq 100 over 8%. And now, this brings us to what we're talking about. Why most investors actually fail to achieve the market return, the average market return, which means most investors actually underperform the market. So on average, on a year-to-year basis, over the past 100 years, the market has averaged between 8 to 10% returns annually. But if you look at the reality for most investors, they actually make a lot less than that. And it's because of a few things. The first reason is this: they tend to often buy high. So when the market begins to go green and it's on a bull run, lots of people like to put their money in because they expect it to keep on increasing. But when the market drops and it goes red, people begin to sell, they begin to panic sell, and they lose out a lot of buying these stocks or their investments at a cheaper price. And last week is a classic example. If you had invested 2 weeks ago and just held on through last week, you will have actually had like an 8% return. That is what the market averages in a year. In a week alone, if you just invested in the Nasdaq, you'll have had just 8%. That is ridiculous, okay? And the market hasn't even fully recovered from its all-time highs from last year, which means there's still a lot of room for the market to recover, get back to its previous highs of last year, and then even exceed that. So if you've sold, you've missed out a significant return from the market now. That's why you really need to listen to lots of the videos I put out and the information I give to you. So the number one reason people fail to beat the market or actually achieve just the average return of 8 to 10% is they often buy very high and then they sell when it's low. The second reason is this: people tend to panic when there's uncertainty in the market. So whenever things happen, if there's a new news in the media, something has happened, whether it's a war or a disease or something has happened, people begin to panic. And when they begin to panic, they begin to make very terrible mistakes in their investment. They change their investment strategies. Some people stop dollar cost averaging, which is adding to their accounts every month. Some people even begin to sell. Some begin to switch from one sector to the other. Like I remember, like last week, I was looking at my strategy and I kept telling myself, or the week before that actually, when my portfolio was still down, I kept telling myself, I'm going to keep investing. And I remember being on Reddit and seeing lots of people saying they were going to switch from one strategy to the other. They were going to short the market. Well, those that shorted the market last week made a lot of losses, because when the market recovered last week, they lost a lot because they bet against the market. So for lots of people, they tend to change their strategies when things are uncertain, and that is a terrible thing to do. You need to hold on to your investment strategy even when things change in the market. Now, number 3 is people try to time the market. They often say things like, I'm going to buy when things recover. I'm going to buy when this news is better. I'm going to buy when COVID is over. I'm going to buy when the war between Russia and Ukraine is over. And they think that by doing that, they will actually make money, but they are actually losing out a lot, because a lot of the returns of the market have occurred when the market is in a downturn. Those days, like last week, when the market recovers, you miss out those returns. So those are the top reasons why people tend to lose and not actually achieve the average returns of the market. Now, the thing for you is this: you can prevent that from happening to you, and I'll show you how. The first thing is for you to do nothing. Yes, you heard that right. Once you've started investing, don't change your strategy. Do nothing. When the market is panicking, when people are uncertain, do nothing. Okay? A lot of mistakes are made when people panic and make decisions out of irrationality. Just do nothing. Shut down your account, go out for a walk with your family, focus on other things you love to do. Don't try to change your strategy. Number two, you need to think of your money like a bar of soap. Now, if you use a bar of soap, the more you handle it, the less of it you have. That's how you need to think of your investment. If you begin to change your strategy and you're buying and selling very often, you shift from a passive strategy to a more active strategy, which means your chances to lose money drastically increases. So you need to just let your portfolio do its job. Trust your investment strategy and let your portfolio do its job. Number three, don't panic sell. If there's anything you take out of this, don't ever panic sell. In fact, I would say when the market drops, you should be buying. Just like whenever there is a sale in your favorite grocery store or a clothing store or brand, you go and you buy more. You have to think of the stock market in the same way. When the market is down, you buy more. You don't sell. It doesn't make any sense in any world to sell when the market is down, because that's the number one way to guarantee that you will lose money, because you're selling when the market is down. Number four, just trust your strategy and stick to it. Know that when you've chosen a good strategy, it's going to work. Give it time and be patient. Just be patient. No one can predict the market, no one can control the market, no one can tell how the market is going to do today or tomorrow or in a year's time. Don't try to change from one sector to the other. Don't try to change from active to passive or passive to active. Just hold on to your investment strategy and trust it and let it work for you. So that's what I have to share with you guys today. I hope you've learned a lot from it, and I hope you're staying invested. Keep on investing in the market. If you've not started investing, start investing today. If you don't know how, click the link below to discover how you can begin to invest. We have a course that is going to come out in April. You can join the waiting list from today. It's first come, first serve. So click, join the link, and you're going to learn how you can begin to invest today and begin to buy your way into your financial freedom. So thank you very much and have an amazing week. Bye-bye.